What emerges most clearly from the evidence is that modern financial crises are rarely triggered by a single dramatic failure. Instead, they unfold through gradual erosion in confidence, a slow recalibration of expectations among investors, institutions, and policymakers. This matters because contemporary economies, particularly advanced ones like the UK, operate on balance sheets far larger and more leveraged than in previous decades. Debt in itself is not destabilizing. It becomes dangerous when belief in its sustainability weakens. The UK's fiscal position illustrates this distinction. Public sector net debt is now close to 100% of GDP, according to the Office for National Statistics, a level that would have been considered extreme 2 decades ago. Yet for much of the past 15 years, this debt burden remained manageable because interest rates were historically low. The cost of servicing debt, not the headline stock, was a stabilizing factor. What has changed is not merely the quantity of debt, but the price at which it must now be carried. Since 2021, the effective interest rate on government borrowing has risen sharply. The Office for Budget Responsibility has repeatedly highlighted that debt interest spending is now one of the fastest-growing components of public expenditure, projected to exceed spending on many major departments. Crucially, a large proportion of UK gilts mature over relatively short horizons compared to peer countries. As older, low-yield debt rolls off, it must be refinanced at today's higher rates. This created a mechanical increase in future debt servicing costs, largely independent of new policy decisions. The structural risk lies in how markets interpret this trajectory. If investors believe that the UK can generate sufficient growth, taxation capacity, or spending restraint to stabilize debt over time, higher interest costs remain tolerable. If that belief weakens, yields rise further, not as a moral judgment but as compensation for perceived risk. This dynamic is self-reinforcing. Higher yields worsen fiscal projections, which then justify higher yields still. The events of autumn 2022 provided a compressed demonstration of this mechanism. Unfunded fiscal commitments, announced without credible institutional backing, cause investors to reassess the UK's policy framework. Gilt yields spiked, pension funds faced liquidity stress, and the Bank of England was forced into emergency market intervention. Although the immediate crisis was contained, it revealed how thin the margin for error had become. Importantly, the underlying conditions, higher global rates, weak productivity growth, and large refinancing needs have not materially improved since. Overlaying this fiscal vulnerability is the UK's external position. Persistent current account deficits mean the country depends on foreign capital inflows to finance both public borrowing and private consumption. This reliance amplifies sensitivity to shifts in global sentiment. A loss of confidence does not merely raise borrowing costs. It puts downward pressure on sterling. Currency depreciation then feeds into import prices, pushing inflation higher and constraining the Bank of England's ability to cut rates in response to slowing growth. This interaction between fiscal stress, currency weakness, and monetary constraint forms a feedback loop that is difficult to escape once established. Higher inflation necessitates tighter monetary policy. Tighter policy slows growth and increases debt servicing costs. Slower growth worsens fiscal ratios, undermining confidence further. None of these steps require panic. They emerge from rational responses by institutions acting within their mandates. What becomes clear is that crisis risk should be understood as a spectrum, not a binary event. The UK is not facing inevitable collapse, but is operating with reduced resilience. The system can absorb shocks, but fewer of them, and with less tolerance for policy missteps. Stability now depends less on headline debt figures and more on the credibility of long-term governance. Fiscal rules that are believed, institutions that are trusted, and policies that acknowledge trade-offs rather than deny them. The danger, then, is not sudden disaster, but gradual narrowing of options, a drift toward a state where more public resources are pre-committed to servicing past obligations, leaving less room to respond to future shocks. In such an environment, confidence becomes not an abstract sentiment, but a form of economic infrastructure. Once damaged, it is slow and costly to rebuild. After examining the data, what stands out is how the UK's current vulnerability is the product of long-term structural choices rather than recent shocks alone. High public debt, Weak productivity growth and reliance on foreign capital have coexisted for years without triggering crisis. The reason is simple. The system was insulated by ultra-low interest rates and abundant global liquidity. That insulation has now thinned. The fiscal arithmetic has shifted in ways that are both subtle and consequential. The government continues to run primary deficits, meaning day-to-day spending and investment exceed revenues before interest costs are even considered. When interest rates were near zero, this was politically and economically manageable. Today, with gilt yields several percentage points higher, deficits compound faster. Borrowing is increasingly required not to expand the state, but to service its existing commitments. This distinction matters because it changes the narrative investors apply to the UK. Borrowing to invest can plausibly generate future growth. Borrowing to cover interest is a sign of fiscal inertia. The Office for Budget Responsibility has warned that, under current policy settings, debt is projected to rise again later in the forecast horizon, reflecting aging demographics, healthcare pressures, and higher debt costs. These are structural forces, not cyclical ones. Market confidence operates as a form of collective judgment about whether these pressures are politically and economically manageable. It is not static. It evolves as new information emerges, fiscal announcements, growth data, institutional behavior. When confidence is high, markets are forgiving. When it weakens, tolerance disappears quickly. The UK's experience in 2022 showed how rapidly sentiment can turn when credibility is questioned. The Bank of England sits uneasily within this environment. Its mandate requires it to prioritize inflation control, yet financial stability risks increase as rates remain high. Emergency interventions, such as temporary bond buying, can stabilize markets but blur the line between monetary and fiscal policy. Repeated use of such tools risks normalizing crisis management, which paradoxically can erode confidence over time rather than strengthen it. The external dimension intensifies these constraints. A country with a current account surplus can rely more heavily on domestic savings. The UK cannot. It must attract foreign capital continuously. That makes sterling a pressure valve. When confidence falters, the currency absorbs the shock. But depreciation is not costless. It raises import prices, particularly for energy and food, embedding inflationary pressure that feeds back into domestic policy constraints. These mechanisms explain why financial crises often appear sudden, but are rooted in long incubation periods. Warning signs accumulate quietly. Higher risk premia, weaker auction demand for government bonds, increased sensitivity to global shocks, greater reliance on short-term financing. None of these indicators alone signal collapse. Together, they describe a system operating with diminishing slack. The distributional consequences of this fragility are uneven. Higher debt servicing crowds out public spending, placing pressure on services disproportionately used by lower and middle-income households. Currency weakness raises living costs more for those with limited buffers. Meanwhile, asset holders are often better insulated, reinforcing existing inequalities. These effects unfold gradually, which makes them politically harder to confront, but economically more entrenched. The most important conclusion is not that a crisis is imminent, but that stability is no longer passive. It must be actively maintained through credible policy frameworks and realistic trade-offs. In a high-debt, low-growth economy, confidence is not guaranteed by history or status. It is earned continuously. When that process falters, adjustment does not arrive as a single dramatic moment, but as a tightening corridor of choices, a slow recognition that the room for error is narrowed. In that sense, the UK's current position is best understood not as a countdown to disaster, but as a test of institutional resilience in a harsher global environment. The outcome remains uncertain. The structure of the risk, however, is already visible.